Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CFO, Joe Thompson from KITS Eyecare. KITS trades on the TSX exchange under the symbol KITS, K-I-T-S, and it also trades on the OTC under KTYCF. The company is currently trading at $5.49 with about 31 million shares outstanding, or about $172 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trevor. Joseph, great to have you back. It's been a little while since we spoke last. Lots of progress, lots of neat stuff that we've noticed here. So appreciate you taking some time with us today to get us, updated on everything. KITS Eyecare, sort of the name says everything, but why don't you explain to us, for those that aren't really familiar with the company, kind of why you guys are doing what you're doing and how it benefits customers?
That sounds great. And thanks, Paul. Thanks, Trevor, for having us back. Always great to see you both, and great to have an opportunity to share the latest on KITS Eyecare. Maybe I'll use the opportunity to just pull a couple slides up here, just to overview the story. Here we go. Okay, perfect. So we started KITS just over 5 years ago. Many are familiar with the category of optical. It's a big category. It's about $70 billion. 8 out of 10 adults require either glasses or contact lenses to get through the day. And most of those customers, have been asking themselves, why is buying eye care still this complicated? Why does it cost so much? Why does it take weeks to get my order? And so we started KITS to solve that. And really, we started KITS to make eye care easy for the hundreds of millions of customers that require it just to get through the day. And to fix it, we knew it wasn't going to be adding more stuff to the category, more steps, definitely not more stores in optical. It was going to be by taking away the waste, simplifying the process, and offering more selection, value, and convenience to the customer. So, as I mentioned, we started in November 2018. We launched the company. It's been a quick rise over the past 5 years. The last reported quarter was Q3 2023. We will report our fiscal year in a couple of weeks, and our fourth quarter on March 6th. Our current run rate as of Q3 is just over 125 million in revenue. We're up over 30% and continuing to be happy with the growth patterns of the business. Importantly for us, this is a category built on the repeat customer. So once you need vision correction, you tend to need it for decades or even a lifetime. And so, so our mission is really to create a place where customers can come for a lifetime. And one number we're always happy to report is the percentage of revenue that comes from our repeat customers, which consistently is over 60%, was again in Q3. We're approaching 1 million active customers, and we're growing, funding that growth from our own cash flow, and have been profitable throughout the year in 2023. So, for this category, just as an overview, it's an important category. It's important to be big. Scale really matters in optical. It's hard to make a difference in this big category if you're a 10, 20, even $50 million company. You really need to get to 100, really 200 million to get the leverage on the model, to start the flywheel spinning, and to make an impact across the category, across North America. And so when we set out, as Roger and I started on day one, we said, okay, how can we grow this category quickly? How can we fund that growth ourselves and get to a big and meaningful size of the business, and really get to that 200 million in revenue, which we're well on the way to? And we said, well, Roger's got a lot of experience. He previously founded and scaled Coastal Contacts, known as Clearly here in Canada. It was TSX, a trade company, went to the NASDAQ, ultimately sold in 2014 for about $450 million in cash. And so he knows the optical category. My background is in operations at Amazon. I've a lot of experience in e-commerce. And so we said, to do this, let's be really thoughtful about how we approach the category. And we said, there's two secrets to tackling this category. Secret number one is start with a smaller category, which is contact lenses. Contact lenses is much smaller than eyeglasses, prescription glasses. It's about a quarter of the size. And it has a lower gross margin profile. Gross margin, 35 to 40%, whereas glasses can be 50, 80, 100% gross margin or higher as you get into all the upgrades. So why start with a smaller, less profitable from a gross margin percentage standpoint category? Well, contact lenses are highly recurring. Contact lens customers are coming back every 3 to 6 months. And so you establish a profit core of vision corrected customers that you can use to launch into the eyeglasses category. So secret number one, start with contact lenses and build that profit core of vision corrected customers, and then use that profit to launch into glasses. And really secret number two is when you launch into the glasses category, start with the manufacturing, build the lab first. Because so much of the profit, so much of the upcharge for customers is in the lenses, in the upgrades on the lenses, and the outsourcing of those lenses. And so it's counterintuitive. Why would you build a lab when you haven't figured out how to sell any glasses? Well, the problem is if you start with the marketing side and selling 10, 100, 1,000, 10,000 pairs of glasses, well, you've essentially built a marketing company or a retail company. And then essentially you're handing over the profit to the third-party lab that you outsource those glasses to. You really have no choice at that point but to charge customers more to recover that cost. And so before we sold our first pair of prescription glasses, we put a couple million of our own capital into the first version of our optical lab, and we scaled that pretty significantly since then. And that gives us the control over the quality and the cost of the glasses so that we can pass the highest quality and the lowest cost onto customers. So that was the story for us, 5 years ago, just over 5 years ago, when we started the company. It was the same mission and story as we took the company public and did the roadshow and went on the TSX January 2021, and that's the case today. And is really helping our business grow at the rate that we've been growing. And so we're happy to give you an overview and share how we're progressing, and we're as excited about the next couple of years as we have been over the last few.
Fantastic, Joseph. Thank you. I want to remind everybody that's listening, if you got a question you'd like me to ask Joseph, please use your chat function and I'll ask a question. Consistent growth. I love that. You guys are growing nicely. Turned profitable in Q3. Going forward, what's the expense line look like? CapEx, OpEx. What changes here going forward? Is there big spends that you still have to do? What can you tell us there?
Sure. So we built capacity well ahead of demand. All of these machines are made to order. They take a year to make and deliver from Europe and install and connect to our technology. You have to build the technology layer on top of the machines as well. And so we have capacity in our Vancouver optical lab for just over 4,000 pairs of glasses a day. And we're only at the 1,000 to 1,500 range currently, so well under our current capacity. We think the CapEx has been deployed to get us to about a double to where we are today. So about 125 million run rate. We think, with the technology, the machinery, the conveyors, the infrastructure that's been built in the optical lab and fulfillment center in Vancouver, that we could double.
Mm-hmm. And how labor intensive is this? Like, how much more staff do you need as you grow?
The machines are incredibly automated, and so from a machine standpoint, we can operate, 4 industrial edgers with 1 technician per shift, and so they scale pretty well. There is some labor still required. We hand assemble and hand QA the glasses, but all in all, it takes about 20 minutes to 25 minutes to make a pair of prescription glasses in our facility. And so, we've built it to scale. The second part of your question is leverage on the model and profitability. It took us about 4 years to go from 0 to 100 million. And so as a public company, you can see what the economics look like at 100 million. It was approximately break even. So about I think it was about 1% EBITDA. So call it flat EBITDA and low 30 to 33% gross margin at the time. So in our view, and important to note, of course, that we haven't put any formal guidance in the market, but certainly we have internal goals. And so as we think about our internal goals, as a team, we said, well, if it took us 4 years to go from 0 to 100 million, certainly the next 100 million, we think we could do faster than 4 years. We've now built the lab, we built the brand, and so we would like them. We're off to a good start now with over 125 million revenue run rate, and so we'd like to have a $200 million revenue business. Over the next 18 to 24 months. That would be our target. And as we think about moving towards that 200 million in revenue as a run rate, what do the economics look like? Well, we think gross margin continues to grow. Now approaching kind of mid-30s, and we think at the 200 million level, we'll have a greater mix of glasses with a higher gross margin and more leverage on and scale on buying, and that we feel will lead us to gross margin in the range of about 40%, or close to it. Fulfillment, we think that there's some greater leverage as we as we put more volume into the model. We'll get more leverage on the other side. A year ago, it was about 14.5%. Was fulfillment as percentage of revenue, down to about just under 12.5% now, approximately. We think there's still a little leverage there to about 11.5 percent. We think there's more leverage in G&A, down to around 5 to 6%, and marketing will probably hold consistent as we continue to find growth, and that's been in the 12 to 14% range as a percentage of revenue. So overall, just again, no formal guidance, but certainly as an internal goal, we'd love to, in around 2 years' time, have a $200 million business, growing, funded with that growth funded from cash flow, gross margins, at or approaching 40%, and EBITDA, at or approaching 10 to 15%.
Mm-hmm. You sort of touched on my next question. As far as any kind of growth initiatives, do you think all of it will come from cash flow, or do you ever envision a need to go out and raise more capital?
Certainly, we've there's a high insider ownership, and we feel like it's really important for all of us as founders of the business and as owners of the business to share the same goals as the rest of shareholders. So our insider ownership is very high 70%. It's almost 80% actually. So there's a small float out there. That is a downside for some with the lack of liquidity, but we really feel that that the stock is tightly held and just continues to move up. Our issue price was $8.50, and so that's an important number for all of us. As a different market in January 2021, of course, but we're fast approaching that issue price, and so we're pretty comfortable to continue to push on organic growth. continue to fund that growth ourselves.
Mm-hmm.
And then, our view is as we get to the issue price and above the issue price around $10, we think it's our view anyway that the liquidity will eventually take care of itself, and
Mm-hmm.
we'll have lots of opportunities come up.
Mm-hmm.
We
I
have
mean, yeah.
we have a simple. It's been important to keep a simple capital structure
Mm-hmm.
for us, so it's all common stock. There's only been one equity raise. It was the IPO in January 2021. As of the last reported quarter, we have consistently a good chunk of cash on hand, about 18 to 19 million in the last reported quarter, a small debt balance to the BDC, and that's it.
Gotcha. I mean, and if we look forward, and you guys are obviously generating more cash flow according to plan. How do we think how you allocate that capital? Like, what do you do as your cash cushion grows? Where does that cash go?
We think there's a lot to be done in the eyeglasses market, and that's definitely our growth focus. And we now have a great contact lens business, a great glasses business, a great U.S. business, and a great Canadian business. And so, as we expand each of those four areas, we think glasses in particular has a lot of room to grow. We're still smaller in glasses.
Mm-hmm.
We introduced at a remarkable price point in the North American market in November 2023, $28 for all of our kits, prescription glasses. And that includes the frame, it includes the prescription lens. And for us, that's the mechanism to invite many to come into the category. A big part of our growth over the last couple of years has been this industry migrating online at an increasing rate, at a faster rate than it ever has before. And really that being led by the millennial customer. And that millennial customer is now the biggest customer in North America and is very comfortable shopping online. So we want to introduce that customer to the ability to recognize a lot of savings on glasses and to give us a try at a reasonable price point of $28. And so what we've been doing over the last year and a half, 2 years, as we've launched our eyeglasses business is really seeding the market with glasses and with new customers. And so as we prepared for the next phase of growth, we were watching closely to make sure that the annuity of those glasses customers comes back. This entire industry is really rooted by repeat customers and the lifetime value of a customer. And so, we've been delighted in our Q3 results. The most recent quarter we've reported, the share of repeat customers was actually even higher than new customers. And so that gives us the confidence to go out and secure the next wave and the wave after that of glasses annuity consumers. So that'll be a big part of our growth. And Canada has been a big growth market for us. The US is still a bigger market for us. It's about 2/3 of our revenue. Canada is a third. But Canada has been growing even faster than the US. And there's a smaller group of retailers in Canada, and we seem to be outperforming all of them, growing about 45% in the Canadian market in Q3.
I was going to touch on a little bit of that. I mean, there's obviously other players. There's some sort of well-known players in the space. What's your competitive advantage? Is it just price, or is there more to it than just that?
We're pretty focused on two things at the core. Number one is to ensure we have the lowest cost infrastructure in the market and the lowest cost of manufacturing and delivering a high quality product. And we feel that we're at that level now. There's really a couple buckets that go into the full cost profile. One is the stores and or lack thereof. And so there's across North America, there's about 45,000 optical brick and mortar shops. And so it's probably over retailed currently. And that retail burden, that legacy burden, the customer's paying for when they pay $300, $400, $500 for a pair of eyeglasses or higher. So we don't have that brick and mortar burden, and so that removes an enormous cost infrastructure. We own the manufacturing and do the manufacturing ourselves, and so there's no third party outsourcing of that. And so we feel that is an advantage as well. And with the scale that we're approaching, we're really getting some scale efficiencies on our fulfillment network to deliver shipments in a day or 2 days, and that I wouldn't say we're at scale yet on that, but we're fast approaching it. And so and maybe the last part is the marketing cost that typically goes in. That would be the third bucket of cost. And we feel with our repeat profile, over 60% of our revenue every year, every quarter coming from repeat customers, it lowers the burden for our marketing expense line. And we're able to do things as a result of not having stores and owning the manufacturing ourselves, like $28 prescription glasses, delivered to your door in a day or two. And those types of campaigns, and we'll even run on occasion a promotion called First Pair Free, where if you've never made a purchase on kits.com in the US or kits.ca, on occasion we'll give you a pair of glasses for free. And our thought process is, the cost of serving a customer with a high quality pair of prescription glasses is fairly low for us. It's about $30. And 10 for the frame, 5 for the lens puck, approximately 5 for labor and consumables, and then about $10 for shipping. And so if you're a new customer, Paul, I'd rather give you that $30 than pay $100 to Instagram or Facebook for marketing and acquisition costs. And so that's created a bunch of word of mouth for us. And so our competitive advantage is, we know this category very well, and we've been operating in it. Roger's been operating it for decades. We ruthlessly maintain the highest quality product at the absolute lowest cost of manufacturing, and then we pass all that savings and quality onto customers, so that those customers come back a second, third, fourth, 10th time, and that's really the business model.
You mentioned 80% roughly of adults have need for eyeglasses or contact lenses. How does one sort of go and purchase, if nobody's ever used Kits Eyecare before? Walk us through the process of actually getting a pair of glasses from you guys.
Sure. So most folks do have a prescription on hand, or will want to get their eyes tested every few years. And so you just come to kits.ca. You can go through and go through our perfect fit guarantee process, where if you have a pair of glasses that fits you, there's 3 numbers on the inside of those. We'll take those, do some more measurements and build your profile out. Or you could just come and use our virtual try-on kits.ca. You don't need to download any apps or anything. It's just right on the browser. Pick a pair of frames in the lens that's right for you, and then within a day or two, they'll be at your doorstep.
It's amazing. I have glasses, and I remember what it's like to go the old school way, and it was a lot more cumbersome than just doing that. Listen, we get a number of questions. I'm going to start asking you some questions from the audience here. I'll start with Rahil asks, there's been about $20 million cash sitting on the balance sheet for the last 6 quarters. Where and when are you planning on investing it? I think we touched on it a little bit, but maybe get one more go.
Yeah, certainly. It's a question that we do get, and I'm glad you've asked it, Rahil. It was important in the market, in particular in the last year and a half, to show a robust cash position as we turn the corner to funding growth from our own cash flow. And so we've really been committed. You've seen that over, as you said, the last 6 quarters now. As we think about expansion, we think a lot about our building our glasses selection out and seeding the next wave of customers. And so I think that's where our investment will be, is new glasses customers, and then introducing our glasses collection to our contact lens active customers as well.
Gotcha. Next question is your expanded capacity. Is your expanded capacity fully operational? If so, what benefits do you see from
it? I'm sorry, I missed the last part of that. Expanded
just
capacity?
what benefits do you get from the expanded capacity?
So with the expanded capacity, it was important for us to invest in that CapEx, installing the machine so that we could scale into it. And so there's two benefits. One is we know we've got a roadmap now from 125 to 250 million. There'll be some CapEx required, some repairs or and occasionally an incremental machine, but we're talking, in the 1 to 2 million range, not significant CapEx required. And so it's the elimination of a burden and the confidence that we can just scale in to the capacity that we built. That's really a key one. The other benefit is that in any business, and ours included, the demand isn't consistent. You'll get, Mondays are always a big day for us. Folks come back to work or to where they are, and there's a lot of orders on a Monday, and so we don't want to waver being consistent with our customer experience. We want to be able to scale up on the busiest days and still be able to manufacture a pair of prescription glasses, within 24 hours of you ordering it. And so having the expanded capacity and automated capacity helps us to do that.
Fantastic. And then what benefits are you seeing from your partnerships with Green Shield and Sun Life? And are you finding orders through these partnerships?
Those partnerships have been really helpful for us, and just the beginning. We love the economics of the partnerships. These are customers that have a vision insurance benefit that renews every 2 years, and so in the case of Green Shield and RBC and a few others, we've been able to do a direct integration with the insurance infrastructure. So if you're a customer of those insurance companies, you can go directly from their portal to our site, kits.ca, log in using your RBC or Green Shield's credentials, and you'll see right on the screen, Paul, you've got $400 of insurance to spend on the site, and for customers, it really gives them the peace of mind, which, as we talk to customers, is the biggest worry. They make a purchase. Okay, I bought a pair of glasses. They were $300, $400, $500. I have no idea what will be covered or when I'll get paid for that. And so I'm going to fill out a bunch of forms and I'm going to cross my fingers and hope for the best. Well, it takes the worry out of the customer's mind. And then importantly, when you get to the checkout, you can just apply that directly to your purchase. So you have no out of pocket. You actually don't need to worry about it at all. We handle it all in the background with the insurance partners. And so we love the infrastructure of it. We love the fact that we can say, no matter where you are in Canada, whether you're in Medicine Hat or Thunder Bay or Red Deer, we know we can get you our full selection of products in a few days. It's not dependent on us having a brick and mortar store in your city. So we know we can serve all Canadians. We know we can offer them exceptional value. I think the one thing that we have learned that we need to be a little bit patient with the scale up of that. Customers come back as they're, gradually as they're coming in. And so they don't necessarily if a certain insurance provider has, 2 million or 5 million or more members, they don't all come in on one day and say, well, now I'm going to start buying eyewear and I'm going to buy it this way. They come in gradually. So it has been not an immediate peak, but just a nice steady incline to our business. And we're excited to add more partnerships to that.
Wow, very interesting. Okay, so now guidance. You've given guidance in the past. Rahil has mentioned that no guidance is for Q4. What's different this quarter?
I assume you're referring to the pre-release. Occasionally, we put out a pre-release.
Correct. Yeah.
Yeah, no, we just continue to feel great about our business. In the past, as we were smaller, we had a lot of questions and did you grow? And we feel like we've demonstrated a strong track record of a number of quarters of growth, at or above the numbers that our analyst partners have put out. And so so we're excited to report in a couple of weeks. It was a great end to the year and a great start to 2024. So I think we're constantly we have got the question, hey, will you guys do this each quarter moving forward? And or at some point will that go away and you just do the earnings? So I think we're still getting feedback from all parties, and but in this case we decided to wait until the earnings. We report March 6th, and we're super excited to share our full fiscal year and our Q4 numbers then.
You mentioned analyst partners. I know PI covers you guys. Who else, if anybody, covers you guys?
Sure. Yeah, no, we're happy that we've had 2 initiations in the last month or two. We're up to 5 covering analysts. Beacon Securities, Doug Cooper, does really, really great job covering the stock. Derek and Luke at Canaccord have been there, from day one. Jason at PI Financial initiated in December, I believe. Matt Corenda at Roth Capital has been there since day one. They were on the IPO as well. And recently, John Luca at Haywood has initiated and wrote a really thoughtful initiation report, which I'd recommend for everyone. And I think we have one additional initiation that we have planned, and I think a stable of 6 analysts is probably a good spot for the next couple months.
Absolutely. Yeah. No, congratulations. Well, you answered this in the slide, but I'm going to ask it again. What is your current percentage of repeat customers?
Yeah, so the number that we break out is the percentage of revenue that comes from repeat customers. And that in the last reported quarter was 64%. And the benchmark that we like to have, some quarters may be slightly above, some slightly below, but across each and every year is 60%. We like to start out the year saying, here's our internal target for revenue, and knowing that we have this robust active customer list, and really setting the bar at 60%. That's for us. It's a test of how strong the business model is. If you have to go out and invest in a bunch of new customers, in a category like this, if you're investing in over 50% of your revenue each and every year in new customers, then it's a less efficient model, and so that's why it's important for us. We focus on having the lowest cost infrastructure as number one, which gives us the flexibility to offer greater value and quality. And then the second thing that we look at each and every day as we come in is Net Promoter Score. So the one question of how likely are you to recommend kits to your friends and family, and traditionally the benchmark for the absolute breakthrough companies is 80 NPS or higher. I believe Amazon's in around an 82 last time I checked. And so that's our benchmark is really 85 NPS and higher.
So clearly, I mean, you're trying all sorts of marketing approaches, and word of mouth is probably the cheapest by far. But what else works? What other forms of marketing works for you guys to increase your customer base?
The influencer ecosystem is a powerful one, and so word of mouth tends, you need to seed it, and so people ultimately, and especially the millennial customer, which is the most important cohort on our business, that represents the future of the optical industry for the next 10, 20, 30 years, and that's a cohort that is about, just this year passed the baby boomers in the US and Canada to be the biggest demographic in population and spending power in North America. And that's a customer that really values a referral from someone that they know and trust. And in a lot of cases, that is some of these influencers, and not necessarily some of the biggest influencers, but really reaching out to folks at all levels. And so we've had a lot of success. I think we're really just getting started with that, with that channel. The other channel, which is probably an obvious one, but is an area where we've done well but could do a lot more in, is just referrals. And so we've recently launched a share repair program where we have customers calling us that in particular a customer that has come through the first pair free program and said, they'll call us after and say, I don't get it. What's the catch? I used to spend $250, $300 and wait 2 weeks and go through, and you gave them to me for free. And they came in a day or two. I don't get it. And so when they call into our customer service line, that the team just says, well, the catch is tell everyone and that's really the best, in our view. That's the best marketing that we can do. And so we're starting to put and our teams is starting to put some bones around that with share repair program. So if you've had a great experience on kits, we want to give you a free pair to share with someone that that's important to you. And for us, that's that $30 investment in that new customer is much better spent on the customer. In this case, two customers, the giving customer and the customer that receives, than just putting more money into Facebook or Instagram or something similar.
Yeah, makes sense. Makes a lot of sense. Okay, so last question from the audience here. This is our friend Trev from the UK. He says multifocal contact lenses and glasses are available here in the UK. Do you manufacture and supply these, and are they more profitable?
We do carry multifocal contact lenses here in the US and Canada. We carry one of the biggest inventories of contact lenses, definitely in Canada, but we feel one of the biggest in North America. And that's torics, astigmatism, multifocal. A growth category recently has been color contact lenses. Originally more popular in Asia, but now increasingly coming to the North American region. So you bet we carry them here. Typically those items do tend to have the multifocals tend to have a little bit more technology, more premium price point in there, and tend to come with a higher gross margin profile.
Gotcha. Joseph, I mean, rapidly growing business, you guys have plenty of cash. It seems like you're dialed in, grabbing market share. But what are sort of the challenges? What's your biggest challenge, or what sort of keeps you up at night right now?
The challenge is really, we are still we're happy with the growth, but we are still a smaller player on the spectrum. And so I think challenge number one is just really staying focused on growth and controlling our own destiny as we do, so that we can continue to operate as we have in 2023, with growth around 30% and funding that ourselves, and get at and above that 200 million threshold I think, maybe the other things that, we're aware of are just and you mentioned it in the question, just the cost of marketing. In 5 years ago now, I've had a long experience investing in different marketing channels, and I was at Procter and Gamble and then Amazon.com, and some of these marketing channels, they will eat all your money for sure. And so I think in particular, as it comes to growth companies, one thing that we've heard is, as we've been a student of watching some of these other companies grow, is there tends to be the risk that the marketing expense line goes up, 20, 25%, 30, 35%, and then erodes some of the benefits of gross margin expansion and leverage in the model. So I think that's something that we're aware of, that we watch very closely. I think we've been able to grow this year, still holding marketing around 13, 14% of overall of revenue, and so I wouldn't say it's a risk, but I'd say it's something that we're very aware of.
Gotcha. And then as investors watching your business sort of from the outside, what do you think the key either metrics or maybe catalysts that we should pay the most attention to see that you guys are continuing on the right path?
The big one for us, this is a stable category, so there's not a huge sawtooth on. In a good year, it grows astronomically. In a bad year, it plummets. People have got to see, and so it's a good consistent growth driver. So the metrics that we look at are the percentage of this category that is migrating online. As the category migrates online, $70 billion category, even if it grows a percentage or two a year in online penetration, that's enormous growth, and that's growth that if you're a legacy provider, brick and mortar stores, distributors, outsourcing, lab and fulfillment to someone else, that it's not really a category that you can compete in. And so I would watch online penetration in contact lenses and in glasses, which has grown very significantly pre-pandemic to now, continues to grow. And I would watch percentage of revenue from repeat customers, because that's really a test of how well is this company serving customers, and are those customers coming back? And that's really the true test for this industry.
Joe, that's kind of all the questions I've got for you today. Is there any key message or sort of key thing you want everybody to walk away with today?
No, we appreciate your support, Paul and Trevor and the whole team. And this category is just a lot of fun. I've worked in a lot of categories, and the draw to the optical category is everyone seems to have a story. And I know, Paul, you said that in previous conversations you've told me about, oh my gosh, I was looking for this pair of glasses, and they came with all this cost, and so it's rare to have an opportunity to work in a category that hasn't really been disrupted yet online, and that has so much to offer to customers. I mean, we'll have customers calling into our call center every day saying, I was waiting. My insurance, my vision insurance expired, my prescription changed, and so I was waiting for 6 months or a year for that insurance to renew, so that I could get a new pair of glasses that I could see in, confidently see in and operate in. And now with $28, you've kind of opened that up to me. So, so I think there's a lot of good that we can do. There's no end in sight for customers who want more selection, more value, and who want the convenience of, hey, I pressed a button, I ordered it, and then 2 days later, 1 day later, they arrived on my doorstep, and so we're super excited to be in this category, and thankful that that others that have been interested in the last year, and the stock continues to perform well, and we've got a small team here. We'll keep our heads down, keep executing, look forward to reporting back soon.
Perfect, perfect. Well, I'm due for new glasses, so you're going to see you're going to see an order from me here pretty soon. Listen, Joseph, thank you for your time. Always appreciate the opportunity to get updated, and congratulations on success so far. And we certainly look forward to catching up with you here pretty soon.
Thanks, Paul.